explain the term monetary policy. Explain the term monetary policy. Explain the term monetary policy. When you talk about monetary policy, we're basically saying that these are instruments that are used by the government through the central bank to regulate money supply. What are these instruments that are basically used by the government through the central bank to regulate money supply? One of it is the interest rate, stroke the bank rate. How do we use it basically to regulate money supply in the economy? We basically say that when there's a lot of money in circulation, what basically the government through the central bank does is that they raise the level of interest rate, and by raising the interest rate, they ensure that there's not much circulation of money in the economy, and in so doing, they reduce what we call inflation. The second instrument, monetary instrument, policy instrument, we call it open market operation. This is buying and selling of security by the government through the central bank. We also say that, for example, when there's a lot of money in circulation, the government basically will be selling security to the public. And by so doing, what they basically are doing is that they make sure that more money goes to the central bank, and in so doing, they reduce the level of inflation. And when they buy security from the public, they increase deflation. The opposite of reducing inflation, they enhance the opposite of reducing inflation. That is what basically we mean by monetary policy. So we put it down. This refers to the instrument. This refers to the instrument used by the government through the central bank, central bank to regulate money supply. Examples, we say examples includes examples include interest rate, comma, open market operation, cash ratio, etc. Again, just to emphasize for the learners, because that was simply on definition, giving what monetary policy means, an example, just to illustrate one of it, just to emphasize what I'd say, that one of the instruments is a bank rate. How does the government uses the bank rate to control the level of money supply in the economy? I've said when there's inflation, to imply then that there's a lot of money in circulation, the government basically is going to raise the level of interest rate, meaning that not much money is available in the society for circulation. And in so doing, I've said that what it does is that it reduces the supply of money in the economy. The second one, I have said open market operation, buying and selling of securities by the government. And to say that when there's a lot of money in circulation, that is during inflation, the government will sell security to the public. And so doing, they reduce the money that is basically in circulation to the public. That is how we approach that. And very important, you need to also check on other factors like selective credit control as also one factor, reserve requirements as also some of the monetary policies. That is how we go about that very question.